So what are these new LLPAs that everyone is talking about? And is it true that you will receive a higher interest rate if you have more down and stronger credit than somebody with lower credit and less money down? And the answer is no, but let me explain. So the FHFA announced back in February that they were making a push to support those who have lower credit scores and less money down. And FHA followed suit with improving their mortgage insurance by 30 basis points, which significantly helps buyers entering the market. And VA also reduced their funding fee by 15 basis points. So it's an industry-wide push to try to help people that traditionally were in categories that made it hard for them to enter the housing market. So let's look at FHFA. FHFA is who governs Fannie Mae and Freddie Mac, so your conventional mortgage insurers. And they have LLPAs, which are loan level price adjustments. So what that means is if you think of it as having a base mortgage interest rate, and then from there are add-ons depending on down payment, credit score, occupancy type, property type, and a number of other factors. And so let's just take, for example, this chart, which shows only credit score and down payment to give you an idea of what this means. So up at the top here are the new LLPAs, and down here were the LLPAs prior to May 1st. So the first thing that you'll notice is that this range here definitely went from 740 and now all the way up to 780, where it used to stop at 740. So let's just look, for example, at a 740 credit score, so we can kind of compare, this line here. So if you were to put 20% down and you have a 740 credit score, you're going to have 87.5 basis point hit to your interest rate price. Okay, so that's here. Interesting enough that if you were to put 25 to 30% down, that you get an improved rate. And if you were to put 15% down, you actually get a better interest rate than if you put 20% down, right? So the strategy here would be you can either put more than 20% down, or maybe you just start by putting, even just 5% down. Look at that. You only have a 50 basis point hit to your interest rate versus a full 100 basis point hit if you put the even 20% down. So one recommendation or strategy could be to put 5% down at the time of purchase, hold the remaining 15% if you wanted to have a 20% down payment, go ahead and close on the loan at the lower interest rate. And then once you've made a payment, we can apply that additional money towards your principal balance and recast your loan so that it will immediately remove the mortgage insurance, drop your payment, and you were able to obtain that lower interest rate at the time of closing. So that is one strategy. But let's kind of compare that down here to the 740 if you were to put 20% down before. So you can see here that prior to this announcement, the more, if you put 20% down, you actually got a better interest rate than if you put 15% down, or than if you put the 5% down, right? So 5% down was a much higher hit than 20% down, and now 20% down is a higher hit than if you put 5% down. So that is the case with the higher credit scores, right? Now, if you go down to the lower credit scores, for example, if you have a 640 credit score, you can see here that your hit now, if you were to put less than 5% down, so maybe you're going to put 3% down, and you're going to have 150 basis point hit to your price. And prior to that, if you had a 640 credit score, it was 275 basis points hit to your price. So what they've done here is they have, while there's still a hit here, it's less than it was before. The hit here, though, for people with lower credit scores is still more than it would be if you had a higher credit score, okay? So somebody who is putting 3% down is going to get a higher interest rate with a 640 credit score than they would if they had a 780 credit score. So you're still going to get better pricing with your higher credit scores. But what they've done is if you have a 780 credit score and you put less money down, you will actually get a better interest rate than if you put more money down. So that is true. So it's just kind of an interesting strategy here from the FHFA. But again, the goal is to help support people that have less money down and to help reduce the penalties for people who have lower credit and less money down so that they can enter the housing market. So, what this does illustrate is that mortgage lending is a strategy. It is looking at all the different pieces of a person's scenario, their credit score, their down payment, their property type, time they're going to be in the home, where the market is, what the future opportunities would be. And now more than ever, it's really important to have a mortgage lender that understands this and can help you position to be as strong as possible in the market. So if you or anybody you know is looking to get into a house right now and want to look at their specific situation so that we can identify how to best position them to get the best possible pricing, our team would love to help. Another thing to keep in mind with this is, instead of doing a recast, know that economists are forecasting that interest rates should hopefully come down pretty significantly the end of this year, beginning of next. And at Intercap Lending, we do offer a free FI, which is a free refinance without any lender fees for 24 months following your mortgage. And so you could simply wait, and at the point that you refinance, go ahead and pay down the loan and reset the loan at that time as well. So lots of different options to consider. But if you have any questions, please feel free to reach out to our team. And hopefully that helps clarify for you what the media is talking about and what this might look like for you or your client. Okay, thanks so much, Ashley Pratt, Intercap Lending. Have a great day.